And we are live. Ladies and gentlemen, we are so glad you are here with us this evening. We're excited to share a little bit about an exciting project we've been working on. Victor, how are you this evening?
I'm great. This is a project that we've been working on now for the better part of a year. It started out originally as part of our storage fund, and we love storage. It's one of those asset classes that is going through a lot of transition. If you go back in the day, storage was primarily a cottage industry, a lot of a mom and pop business, and today it's increasingly an institutional business. Well, that turns out to be the exit strategy for a lot of players in storage, is the notion that after a period of time, operating, getting properties performing, stabilizing, there's often an exit with institutional players, especially in primary markets, but increasingly now in even secondary and tertiary markets. So excited to talk about this. We have a few more folks trickling into the meeting, and so we'll get started here in just a moment. Where do you want to start?
We will go ahead and begin the slides, except I will, as people are trickling in, I'll publish a little poll. If anyone here has ever been to Houston, Texas, share that with us. That will help us orient the familiarity you may have with the market and the sub-market as well. It'll be interesting to see. If you look at your screen, you should be able to respond to that poll. And so far we have 100% yes. So people know it's a great place for seafood and a few other things as well. All right. And we will get the slideshow going while we are waiting. We're still at 100% yes. So the folks are familiar with Houston as it stands. You all should be able to see our slides right.
We can.
And we've got just a quarter of our attendees have not been to Houston. Everyone else familiar with Houston. And so that is great to know as we begin talking about some of the context. Victor, why don't you take it away?
Okay. Well, we're here to talk about a new ground-up development project, and it is spelled Kuykendahl, but if you're a local, you pronounce it Kuykendahl. There's no R in it, but just pretend there is, and you'll sound like a local. So it's called Kuykendahl. That's the name of the street that it's on, and that's why we're calling it by that name. This is the usual disclaimer. It's a bit of an eye chart in the sense that we're making forward-looking statements. None of us have a crystal ball. If this is something that is of interest, you'll have an opportunity to review a number of documents associated with this project, including the offering memorandum, and this disclaimer will also be in that same offering memorandum. So this forms part of that presentation. Whenever we look at a project ourselves, we look at it through the lens of three things. Who is the team that's associated with that particular project? What is the segment of the market, the very specific sub-market, and what are the dynamics in that sub-market before we even talk about the project specifics? So we look at all three of those, and we think you should as well. So we've organized tonight's presentation following this framework so that you basically look at it the same way that we do.
It's worth examining that first element of team by beginning with you, the investor. You are a partner in the project. You are a partner with Y Street Capital, and so that engenders a discussion about partnership. Of course, all of our partners are accredited investors. If you're not familiar with that term, it's defined by the SEC as someone whose net worth exceeds $1 million, excluding their primary residence, or you have an income of $200,000 per year for the last 2 years, with a likely instance of having that again next year. There's also marriage opportunities as well for accreditation. But we also want to know that you're a right fit from a liquidity basis and from an investable basis. So we have those discussions with you in our discovery calls, which we will discuss at the end of this presentation. But for you as a considered partner in this opportunity, these are some of what the team looks like from the limited partnership basis. Of course, we also want to know that you're interested in what development offers, which is that ultra high return the high growth part of your portfolio. But we also have another share class in this opportunity that we'll talk with you about, which gets debt-like returns. And so we'll, again, discuss that later. But as a part of our team, this is what we discussed with you.
And by the way, I think it's worth mentioning that whenever we have a conversation about investment, we're not here to sell you on anything. We're not here begging for money. Far from it. We're here offering you an opportunity to collaborate with us on a project, and that has to fit for you. And we think of it very much like a pair of shoes. And if a pair of shoes are on sale this week, but they don't fit, you're not a buyer. And when we talk about shoes, everyone gets it. And all of a sudden you start talking about investing and people get weird about it. It's exactly the same. So, it's really got to feel like a natural fit. And if that fit isn't there, then by all means, don't do it.
In terms of why Y Street is excited about this opportunity, we have to back all the way up to the vision and the mission of Y Street. And our mission is to build communities that people feel compelled to call home. This occurs through our three divisions: the land development division, purchasing raw land and working through entitlements and zoning, and often the horizontal and vertical as well. The self-storage division, which you have walked in the front door of at this moment, and then our multifamily division as well. And the self-storage piece fits in because every community has its consumer goods, its needs to store its items for businesses, for individuals, for families moving. And the self-storage division is one of the underpinnings of a successful community, the ability to put your stuff where it needs to go when it's not with you in the home or when you don't need it on a daily basis. And that is why we choose these types of opportunities. What you see here is the 5 partners of Y Street Capital, and I'll go through them individually, but they have come together over the last decade to work on projects together across North America. Many of them are out of Ottawa, Canada, but we established our U.S. base and grew down to working on the majority of our projects in the United States. And I'll walk through who is on the team. You may have heard of Victor Menashe, our senior partner. He's around here somewhere. And Victor has a Real Estate Espresso podcast that, if you have not been a listener in the past, I dare you to dabble a little bit in Real Estate Espresso podcast. You may find that to be a very familiar part of your routine. Victor's been a full-time investor since 2009 in real estate projects and developed across North America as well. Amy Johnson is another partner in Y Street who has an absolutely inspirational story as a former teacher who began investing in real estate over a decade ago and found that this was her calling in life. And so when she shows up on podcasts like the Invest Her podcast or Bigger Pockets Story, you get to hear Amy's journey and her own development experience and what she's brought to the table as a partner in Y Street. Of course, we also have the 2 founders, Matt Maxim and Patrick Trahan. Matt brings an incredible insight as the founder into organizing the business to keep it running efficiently and in a lean manner, but with the right deliverables and the right discipline to keep our projects going. He, again, began out of Ottawa, Canada, expanded into the U.S., and as the founder, helped to stitch together the early team, which is now what you see today. Patrick, on the other hand, an engineer by trade, is a mathematician. He's a savant at underwriting. He has a brilliant insight on what is required to draw out all the details of running large real estate investments and determining down to the microscopic level what elements we need to include to ensure that we are appraising successfully a project that will occur in our portfolio. And finally, we have Paul Hanchard, another partner in Y Street with a military background. Paul drives the discipline of our projects. And so when Paul starts speaking authoritatively in the company, we're about to make some rapid progress in our projects because his military background and his insight on systems and the technology that is driving the Y Street projects are all running at a harmonious method. Finally, Skylar Hartman is the owner of Your Way Storage, the management company that's interlaced with Y Street into our self-storage division. Skylar operates across multiple markets, and we're thrilled that he will be the operator of this site that we're going to talk about later today. So Skylar is great, and he's, again, the owner of the management company who is involved in this project. To talk a little about Y Street's strategy, when we look across North American markets for opportunity, we're looking for the areas where supply and demand is clearly in imbalance, where we are seeing that there's an opportunity to deliver something to the local marketplace that is clearly in demand, where obviously the supply is constrained and we can produce something that the community needs. And of course, when it aligns with our vision to build communities that people feel compelled to call home, we're able to cover any market and say, we feel this is a right need and we can deliver a project successfully. So it becomes a very deliberate process, and we don't do an infinite number of projects every year, but when we choose one to share with you, there's a reason for it. The current general partnership team has about 100 million assets under management. It's not a really relevant statistic when we're developing land and moving it off of our books at a fairly frequent rate, but it gives you some sense of the team's experience. We raised about $46 million across the years of operation, and we have about 1,900 acres of land in our portfolio, as well as about 1,400 units under development on the multifamily side. Self-storage side is of some similar number as well. Self-storage is particularly fitting within the Y Street Capital portfolio because of what it delivers to investors like yourselves. In a self-storage asset, you can build it for a certain dollar per square foot, but it often rents for the same dollars per square foot as a comparable multifamily property. That means that the cash flows can be incredibly high in comparison to other assets that have renters. And we love that aspect of what it provides to investors who are involved with us. Equally, that recession-resistant component of self-storage is something that we'll come back to visit, but in any element of the economy or in the cycle, that recession-resistant piece becomes essential when you're looking for the cash flows to sustain you when perhaps other projects do not do the same across economic cycles. You're familiar that maintenance is not a challenge in self-storage. You have numerous tenants all renting small boxes, 5 by 5, 10 by 10, 10 by 15, and across a 4-acre site, you have a very diversified income stream that essentially drives the cash flow that becomes so successful in self-storage. And finally, when you're building a new project, you understand that that building experience to get to the cash flow streams when a renter is involved causes great capital appreciation. And for your portfolio, that's why we enjoy building these assets. The recession-resistant piece is interesting to think of because when you think about economic growth, consumers are consuming additional consumer goods, they're purchasing more stuff, and you need a place to store it. In economic downturns, that model switches, except for they've already consumed the items. Now they need to increase the density of their living situation. Parents move in with children or children move back in with parents. And as density increases, as people begin to downsize, they need to move their stuff into storage. And so it maintains its rhythm in all economic cycles, both in the growth period and in the recession period as well. So we love that about self-storage, and it becomes clearly trackable since the 1950s when self-storage began, and since the 70s when it really started to take on a nationwide exposure to this specific asset class. That flexibility and that ability for a tenant to rent a space, store their stuff, and keep it there because it's not easy to move also drives its resilience during all the economic cycles. Victor, I believe this is back to you.
When we look at the supply-demand situation, what we find, and if you've heard me speak about storage in the past, you would have heard me say, especially any time in the last year, that many primary markets, if the city has an NFL football team, chances are that market is saturated with a lot of new supply. And that is the case in a lot of primary markets. But there are exceptions to that. So, we as a company are focused certainly on secondary and tertiary markets, and we are focused on what we call Swiss cheese opportunities in primary markets. Those are areas that happen to be underserviced for whatever reason, often just inefficiency that occurs naturally in marketplaces. And we then look for those points of inefficiency and look to plug those holes in the Swiss cheese. And this is precisely one of those situations. It's one of the holes in the Swiss cheese where we see a gap in the marketplace. And sometimes that gap can be a gap in quality. It can be that there could be, some older facilities that are mom and pop run, and the institutional players have not come into that particular area. There can also be special situations where, for example, there might be an increased need for professionals to store client records. So sometimes you need to complement that storage offering with document shredding and secure document destruction, things like that are useful for doctors, lawyers, dentists. They then take those boxes by date code and just shred the entire box based on date code. So there's opportunities for supplementary income streams associated with these products, especially in primary markets. Now, a lot of people, especially in 2018, when Hurricane Harvey hit Houston, were really, a lot of the headlines were predicting the death of Houston as a city. And it's really turned out to be quite the opposite. I mean, historically, Houston's been adding about 60,000 residents a year. Despite all of the predictions to the contrary, after Hurricane Harvey, they added another 60,000, then another 60,000 after that, and so on. And it continues to be that way. Houston's a little bit of a different market nationally. People don't go to Houston to retire. They go there to work. It's a working man's town. And if you think about just national demographics, 65% of our nation own houses and only about 35% rent. Well, in Houston, it's the opposite. It's close to 60% renter market. It's a vast universe. So the market dynamics in Houston are a little bit different. That means they don't have garages and basements in which to store their stuff. So there is an increased demand for storage in the Houston market on a per capita basis compared with other markets. So it's important to understand the market dynamics of the city that you're in. We are, and this, a lot of the credit for this goes to Skylar and his team, and that's really focusing on using technology to drive down cost in the operation of these facilities. You definitely don't want 100% unmanned facilities because that's a recipe for eventually losing control of your property. But you also don't need a tremendous amount of manpower because manpower is expensive. So it's finding that ideal balance, using technology where appropriate, using surveillance where appropriate. And one of the things that we love about Houston in particular is that Houston is a market where, especially in industrial, actually leads the nation in terms of construction cost. Building industrial buildings almost anywhere else in the country is $120, $130, $140 a square foot. Consistently, Houston comes in below $100 a square foot. And we've been, digging in and trying to figure out why that is. But it's just a pattern that we have seen and is validated again on this project with the quotes that we've received for construction of this facility. We're coming in consistently again below $100 a square foot. So it makes the economics of building in Houston better than many other parts of the country. The other thing that's interesting, of course, about Houston is it has no zoning. And so it makes it easy to get things entitled. If you pass the fire marshal, get your utilities allocation and so on, you can build. And that's one of the things that we love about Houston as well. So we pull all of these various elements together, the location, the technology, the operations experience, the operations expertise, into a winning product. Now, the specific property is just under 5 acres. We'll be building a total of just under 114,000 square feet of self-storage. These will be a mix of different unit sizes, everything from quite small to quite large. When I say small, 3 by 5. When I say large, 10 by 20, and everything in between. What is important in a market like Houston, because number one, it's hot. Number two, it's humid, is to build climate controlled. Now, there's always demand for non-climate controlled because that rents at a discount to the market. But most people, if they care about their belongings in a market like Houston, they want it to be climate controlled. And so we have a higher proportion of climate controlled in our design than is the norm in the market. And we believe that that is the right decision based on all of the metrics that we've seen in the area. Houston is, as I mentioned before, a huge renters market. This particular property is surrounded by a lot of multifamily. Houston in total is over 670,000 multifamily apartments. It's just a massive market. Wrap your head around that number. But even within a radius of our property, we're at 8,700 multifamily buildings, not multifamily units, buildings within a radius of our site. And pretty much in line with the rest of the city. 53% of the housing units are rentals, a little bit higher percentage of owner-occupied units, but still very close to the market averages for Houston as a whole, with a very high percentage of rental units. It's a steady growth market. As I mentioned before, it's continuing to grow. There's a lot of headquarters that are moving. Houston has a history as being considered an oil and gas town, and certainly that is one of the economic anchors. But increasingly, it's much more diversified economy. It's healthcare. It is technology. Hewlett Packard has their enterprise division has a very large presence. In fact, a lot of that came out of the vestiges of Compaq, which they acquired back in the day, and eventually became the enterprise division of Hewlett Packard, and then got spun out as a separate company when Hewlett Packard got broken apart. And so the headquarters for their enterprise business is in Houston, and a number of many other technology companies are based there. Houston is one of the largest ports in the nation. The port, Houston is inland, but the Port of Houston is actually one of the largest ports in the nation. So it's a huge transportation hub nationally. So when we look at a particular project, we're looking at a radius, generally a fairly small radius, especially in a large city like Houston. We're looking at traffic patterns, and we look at what's happening in the market. How many square feet are available in the area, how much of it is climate controlled, and so we see a real need, a real shortage in particular for climate control. That's both temperature and humidity, because Houston is so humid for the better part of 6 months of the year. So at this stage, we've been developing this project for quite some time. We've been working with the architecture team. Our build partner is Spartan, who are based out of Golden, Colorado. They themselves are also a venerable storage company, but they have an in-house construction company as well, and they work with us. Now, this will be the second project we're working with them on, building ground-up storage. They're very capable. They really are a fantastic build partner, and we don't see the fact that they are also storage operators as competitive at all. We don't feel any kind of competitive nature to any of the discussions, and they work with us in a highly collaborative manner. So we're thrilled to have that team on our team. We expect it's about a 12-month timeline to build a facility of this size. So we would be, finished construction in around the fourth quarter of 2025. Storage typically takes a little bit longer to stabilize than other assets. You might lease up an apartment complex in 6 to 10 months, but a storage facility, especially one of this size, is going to take a bit longer than that, and we've built that into our pro forma. When you create as much value as we are in a project like this, then the refinance into permanent financing really is an opportunity to get an interim exit where we can often return most, if not all, of the initial equity investment to the investors. And then, of course, you still have ownership. So then, we're producing cash flow at that point, but your chips are off the table. So it really trends towards that infinite return model that everyone is after. And so we view that refinance event as an interim exit, which of course is not a taxable event. So that's a beautiful thing.
Victor, you mentioned the stabilization period. And when you think about the customers that we will be speaking to take advantage of this new construction facility, it describes the 4 Ds of storage. And I'll throw this in there right now. Sure. There are 4 main drivers of storage. And for you, the listening audience, which do you feel out of those 4 Ds is the most prevalent? That's the downsizings, the divorces, the displacements, or deaths in a family. And I do have this answer, Victor, so I'm curious if you know it already, but one of them typically is seen as the most prevalent in the marketplace. So if any of you have an idea, and don't give it away, Victor, if any of you have an idea, share it with us. Currently, no one has an idea. So out of all of our attendees, that current question is a good one. Why don't we take the next slide while people answer, and we'll come back to the poll.
It's funny because, when I think about it, I also think about it just as very much location dependent. So, for example, if your storage facility was next to a university, then I don't think it would be any of those Ds. It would be something else entirely. So it really is very much location dependent. But I'm curious to see the answer myself. So the location, again, it's in the southeast quadrant of Houston. We've got some what I consider to be very aggressive bids, and it's not like we've been twisting anyone's arm or anything like that. Of course, Houston has some unique requirements. We have to build to hurricane category 5 hurricane codes, and you would think that would cost more, but we're able to build very cost effectively in the Houston market. Combination of a very attractive and skilled labor force, as well as materials. Many of them come in through the Port of Houston, so there's less transportation cost associated with them. So it's one of those areas that really leads the nation in terms of building industrial type product cost effectively. So the opportunity, you want to go to the poll?
We'll stop the poll for a second. And sure. We got equal guesses. 33% answered downsizing, 33% answered displacement, 33% answered death. Typically, nationwide, the answer is downsizing. As you look at the demographic trends, you see the most people looking to get out of their 2,500 square foot single family home with no children and no more animals living there and downsize, but they cannot let go of the couches and the immense amount of photo albums, and they downsize, but they put those items in storage. So then their kids and grandkids get to clean it out in 20 years. So the downsizing effect is often what drives people to utilize storage facilities, typically nationwide, but 33% of you were correct.
Yeah, and that makes sense. In fact, one of the things that we see as well, and you talked about this a little bit, and when we talked about things being storage being recession resistant, even retailers that are looking to shrink their footprint often have a commercial need for storage, and they will rent self-storage facilities. They don't want to necessarily go out and get a warehouse. They don't need a warehouse, but they have excess inventory and need a place to store that. So we often see businesses using storage facilities. We see e-commerce businesses operating their e-commerce business out of a self-storage facility. So the uses of this space are just vast, often things that we don't even think of. So the offering itself, we've divided it into 2 offerings because it's never one size fits all. Some people prefer just straight cash flow, and so the Class A1 offering is a simple 10% interest only. It's a 5-year term, and it's very simple, very straightforward. You almost think of it like a bond, because that's conceptually what it functions like. The Class A2 is an equity investment. It has a 5% preferred return floor, as well as an equity component. It's a higher rate of return, also carries with it potentially more variability, but also greater upside. So it's, what's your favorite flavor of ice cream? Some say vanilla, some say chocolate. There's no right or wrong. It's just whatever suits you better. So the A1 shares that are interest only over that 5-year period, we would expect that to yield $150,000 back in your pocket. The interest will be paid out on a quarterly basis. And the A2 shares with a combination of both the preferred return plus the equity. So there's cash flow, of course. There is appreciation, because we're creating a tremendous amount of value in this project. And you'll see when we get into the numbers of how this project is structured that we're, in fact, creating a tremendous amount of value here. There is a significant advantage for the A2 shares for tax purposes. We will be performing a cost segregation study on the project, which means that a portion of the capital assets would be eligible for accelerated depreciation. And that can also include bonus depreciation. Now, depending on what happens with bonus depreciation, I know the extension of the 100% bonus depreciation just got voted down in the Senate. Maybe we'll see what happens post-election. Maybe that'll get resurrected. But there still is bonus depreciation, and so there would be eligibility for that. But one of the beautiful things about depreciation is that depreciation expense, if it is, it's not a real expense. So it creates a paper loss. And that paper loss allows the cash flow that comes out of the project essentially to come to you tax-free. So that's a beautiful thing. It one of the real benefits associated with these types of projects where there is a depreciation component, especially if there's an accelerated depreciation component, you can really take advantage of that. Now, oftentimes people ask the question, and by the way, I'm not an accountant, not here to give you tax advice, let alone you don't want to be taking U.S. tax advice from a Canadian on a webinar. You definitely want to talk to your CPA. But one of the things that we see is that when you have an asset that is depreciating on a shorter time scale, let's say it's on a portion of the project is on a 5-year depreciation schedule, at the end of that 5-year period, at least on paper, those elements are fully depreciated. They're fully consumed theoretically. So there is no depreciation recapture on those elements. As often a lot of people think, well, who cares about depreciation? You're just going to end up with a higher capital gains or capital gains depreciation recapture. It's not as simple as that. It's more nuanced. And again, you'll want to get tax advice from your own CPA because, of course, everyone's circumstance is different.
And if your CPA doesn't mention the time value of money, ask them again.
Absolutely. Yeah. Let's talk a little bit about management fees. We're not here to get rich off of fees. The purpose of fees in a project are to protect the investment. So think of it that, if one of us gets sick or becomes incapacitated, there needs to be money in the budget to hire somebody to do that work. And if that money is not in the budget, then the sponsor of your project is doing you a disservice. That money needs to be in the budget in order to make sure that all of the vital functions getting a project from start to finish are there and properly budgeted and funded. And so that's the purpose of these fees. and they're at different points. We disclose them very transparently. They're here. They're in the offering memorandum. So happy to answer any questions about that at any point when we get to the Q&A section. Let's talk a little bit about sources and uses. Where's the money coming from? Where is it going to? What's it going to be used for? So just about $4 million in equity. Project total is $13.3 million. And then we'll be looking to raise the balance of the capital in construction financing, and then that would, on stabilization, convert to permanent financing. We're creating enough value here. If you look to the right-hand side, the project cost is $13.2 million or $13.3 million, but we believe the value based on market cap rates should be something north of $22 million. That means that if we refinance the project in its entirety at $13.3 million into permanent financing, we would be, something in the range of about 55% loan to value. It's a very conservative loan to value ratio. So, the key is to make sure that you're generating enough value in a project. Now, let's talk about where the money's going. So there's about $1 million in the land, about $1.5 million in soft costs. These are things like architecture fees, impact fees, taxes, insurance, all of those things that are not tangible hard costs associated with sheet metal and putting a shovel in the ground. The hard cost just under $9 million. As I mentioned before, it's well below $100 a square foot, and so we're quite excited about that. And then we've got a healthy amount of reserves, and the reserves fall into three categories. Number one is a working capital reserve for contingency in the event that there would be a cost overrun on the construction. There are reserves for the interest reserve on the construction loan. There is a reserve for what we call initial operating deficit. So the day that we open, we have a high degree of vacancy. We still need to carry the property, and that initial operating deficit needs to be covered by a reserve, and it is. And then we have an initial operating deficit reserve contingency fund. So that reserve gets broken down into four components. The fees in total come to $732,000 for a total of $13.3 million. So that's where the money's coming from and where it's going to be used.
For you, the investor, I remember when I was first learning this industry at a higher level, I felt like money moved in an obscure fashion throughout projects, but it is actually not factually the case. And you can see on the screen here, there's a very clear flow when revenue is created where the money flows afterwards. As you can see, the operating expenses get paid first to run the facility to ensure the investment does the thing that creates the revenue, that supports all the expenses. Debt service is paid. Again, if you think of your own home, you pay the mortgage before you redo the landscaping or whatever, but debt service gets paid next, followed by the management fees to ensure the people running the project are being successful in creating the revenue, followed by the preferred return to you, the investor, followed by the partner distributions to everyone involved in ownership, whether that's Y Street Capital or management team, you, the investor. That is the flow of capital from revenue all the way to your checkbook, or rather your bank account. That flow is very clear and very outlined.
Equally, I think it's also worth mentioning, and I don't know if we actually talk about this. There's one more element to the waterfall that's important to mention, and that is when it comes to distributions, we focus on return of capital to investors before we talk about distributing cash to, in particular, the general partner group. So that's an important element to remember, is we focus on return of capital before a profit split. So the profit split is calculated after that return of capital.
Equally, the capital stack, the entire amount of money invested in the opportunity, also has a very clear outline as well. And this reinforces Victor's exact comment. Senior debt is paid first, whether in a refinance event, a sale event, or in the general operating time period between now and 2028 or 2029. That senior debt is handled first, followed by the A1 share class receiving its interest-only distribution, followed by the A2 class also receiving its preferred return. And then after all is said and done, the 70% ownership goes to those two classes, with the 30% going to the general partnership team, what's described as carried interest. Revisiting these slides will help you understand this if this is a new concept for you as an investor. But again, if you compare this to your own home budget as an example, similar things occur. On the debt side, targeting a construction interest rate of 9.5%, getting other quotes on other projects right now that help us find that equilibrium as being a realistic expectation. Permanent financing would be indexed to the 10-year treasury plus the offset that occurs when taking out commercial debt on properties like this. We mentioned that 1.25 debt service coverage ratio will exist when we are at permanent financing. And I think our current expectations are by the third year we'll be up near 1.75%, which reiterates the fact that self-storage is a very strong cash flowing asset class. So debt coverage does not become an issue, but permanent financing will happen at that 1.25 debt service coverage ratio position. And eventually a 70% loan to value will be applied as well. And it's a fairly seamless transition from the construction financing to the permanent financing, but this is why we are the professionals and you are the investor. So we handle that transition period. There are risks to every investment, and here are three that have been top of mind for us as we have looked across this project and said, what did we miss? What do we need to study further? What do we need to draw out to ensure that we are handling investor capital and our own capital wisely in this opportunity? First one is security concerns around self-storage. Thankfully, I was actually looking at the map today. There's police stations there's two within about a 2-mile radius in all directions of this facility. But as you have a place where a lot of valuable items are stored, but not a lot of people living around there, on a 4-acre site, this is a concern. But security items, surveillance, lighting, the actual construction of the building all reinforce the security elements of what we do. Not to mention the fact that, yes, you have other high quality facilities such as like the Porsche dealership down the road and Lamborghini Road nearby. But in this marketplace, we feel good that we are creating an asset that is self-secured, not just contextually secured. So that is an issue to watch out for when you're making self-storage investments. And we feel good about this one. In Houston, like Victor mentioned, you could think of that marketplace and assume, hasn't everyone thought of self-storage? Not only do we feel that the climate controlled element is a clear description of why this project is so specifically valuable, but the market study itself suggests that absorption is extremely high. In Texas, it's actually higher than the nationwide average, but even when you look at the nationwide average, you see that this specific market, the 2 miles in any direction around it, needs about the facility volume we are providing. The 100,000 square feet is actually market demand currently existing that they are asking for. When you apply the Texas levels, they're actually asking for about 2.5 facilities of our size in the local market. So again, the absorption is very high. When self-storage facilities are provided, people put their stuff there. Balances some of that concern about hasn't everyone thought about self-storage in Houston already? Well, apparently not here. Finally, in Houston, you may have noticed, as in other markets across the Southeast, insurance is a concern. When we look at real estate opportunities, we compare that concern to the other issues in investments across the asset classes. We're much more confident handling rising insurance costs than we are about the equity markets and some of the volatility there, because we can analyze if insurance becomes a risk, how do we mitigate that risk? We stress test it. We say, what if the price for insurance on this facility rises 10%, 20%, 30%, 40%? How do we handle that? It's probably never going to go in such an unexpected direction, but we can measure this and analyze how does the facility perform in that context. So when we're measuring things like insurance locally, we say, all right, are we handling this issue? And do we have enough other elements in place that drive a strong project, even in the cases where something unexpected happens, like an insurance run up of a premium on an annual basis? Whenever we're looking at a project, we're following this process, a deep level of design. Victor mentioned we've been working on this project much more than a year. And that design piece is essential because when construction begins, we want them to build and finish as rapidly as possible. There's no adjusting when they begin laying the foundation of this facility. And so the design space is such an essential piece of determining what's the highest and best use in this marketplace, and how do we deliver a project that people feel compelled to use. So once the design is done, we go to the build phase. We select the best partners in the market that we are in. We have our local teams. We have our local people on the general partnership team, and of course the local builders as well, to do the build phase. And then finally, once we're in operation, once Skylar and his team have begun the lease up phase, we study the previous year and the previous 18 months to say, how do we optimize this for the next iteration? Thankfully, you as an investor are benefiting from our previous reviews that have said, this is the way we succeed with this type of asset in this type of market, with this type of context. And so the process is very ingrained in the team's rhythm of pursuing these types of projects.
I think it's worth mentioning, in fact, in Houston in particular, we have one team member on our team who we have not mentioned because we work with him very closely on the multifamily side. His name is Bob Keener. I mean, he's in his 70s, and he used to be a general contractor in Houston. He's built about 10,000 units of multifamily apartments so far in his career. He's built industrial buildings. He built the parking structures for Houston Hobby Airport, over 1 million square feet of parking structure at Houston Hobby Airport, all post-tension beam construction concrete, which is a very high-tech form of concrete. He's built hotels, restaurants, you name it. So we actually do have some unique expertise within the organization. And his son is actually interning with us in our business as well. So we have some bench depth here, in particular in the Houston market, that maybe not everyone else does. I just wanted to throw that in.
And as we reach the end of this webinar, begin preparing your questions. We have a brief question and answer period before Victor will conclude with a little story to round out this exact experience you've been on with us. So prepare your questions, because we're reaching that point. For you, considering your investment opportunities, if you have not gotten to know Y Street very well, your next step is to schedule a discovery call. That is where we will lay out with you what your investment objectives are, how we can help you achieve them. And if this is a right fit, we'll have that conversation. But getting your goals on the table and your vision for where you are taking your financial life and your life in general is the first discussion that we have. And so if you need to take a photo of that QR code, that can help you schedule a discovery call to begin. If you're tired of talking to Victor or Robbie and you say, I'm ready to get into the investor portal and review this more thoroughly, you can create an account. That QR code will take you there. This specific asset will have its documentation ready in a couple of days. And so communicate with us if you're saying, yep, I know you and I like you and I would enjoy being involved in the Houston self-storage marketplace. Let us know so that we are ready to deliver the documents to you, and you'll need an account in the investor portal to begin that process. So that QR code will come up again in a couple of slides, but afterwards, you're going to walk through the documents. We will walk through them with you. And of course, when you are ready to wire, you'll receive your one point of contact and begin a partnership relationship with us. And we're so excited to have you along with us. there are other projects we've done that we don't have time to review in this session, but across our different divisions of Y Street Capital, we can share with you some of the lessons we've learned and experiences we've had building assets across North America. And so here's just a highlight of a few of them currently active or currently in process, and some of the work that we've done we can share with you in the discovery call or in other areas. Finally, Victor, if you're ready to share that value story, we will conclude with that. But we do have a great question already submitted from Jack. So Jack is asking, given Texas weather, delivering climate control will consume power as a large cost item. So have we considered incorporating solar into the overall design? He's got a follow-up question, but what's our construction team saying about solar?
Yeah, that's a good question. And it's something we're looking at. We haven't made a firm decision on it. We are looking at it. This is where it is most compelling, is in those locations where you can get a combination of three different forms of subsidy. There's the 30% investment tax credit under the Inflation Reduction Act, and obviously that helps defray that cost. The second is that if you happen to be in a rural area that's governed by the U.S. Department of Agriculture under their REAP program, you get a further 50% grant from the Department of Agriculture. Now, 80% of your solar installation is paid for by Uncle Sam. And then if you happen to be in certain economic zones, you get a further 20%. So it's possible mathematically to have 100%. That's nirvana. That happens very rarely. This, of course, is well above 50,000 population, so it would not fall under the Department of Agriculture map. We are looking at it. We are in the process of getting some quotes from commercial solar contractors, but we've not made a decision on that component. We're treating it almost like a separate add-on that might be a kicker to the performance of the project, but we have not made a decision.
Gerald asks another good question, which is, share with us the status of the construction permits. What are we hearing from the city of Houston about this asset as of right now?
City of Houston is fairly easy to get through the permit process. Unlike other cities where you have to go through zoning and quite an extensive process, Houston does not have that. You have to pass fire marshal and be compliant with the International Building Code, and you need the MUD letter. MUD is an acronym that stands for Municipal Utilities District. So now storage facilities don't use a ton of water, so the utilities allocation that we're going to be looking for is not very significant. If we had a 4-acre site that was all apartments, then that would be far more important. But getting through the permitting process in Houston is actually quite straightforward. And again, having guys like Bob Keener on our team really helps that. And we have gone with a local architect who really knows and understands the local codes in Houston. They are a little bit different from other parts of the country. Have to build things to Category 5 hurricane and so on. So there's a few things that are special about Houston, and I feel very confident. Just looking at the quality of the construction drawings that we've received from our architect, that I'm not expecting a ton. I'm not expecting a ton of red ink all over them from the plans examiner.
Another question comes in about our status of financing, and we outlined our ideal financing terms, but Victor, what are we hearing from our banking relationships at this point about the financing for this project?
We're still early in our discussions with lenders. We are in discussions on a very similar size project right now in Colorado. And so we're fairly advanced discussions. So we have a pretty good sense for what the lay of the land is in the lender community. and we're not overly concerned. We have a pretty good sense for what the terms will be from several lenders. We don't have a term sheet in hand right now, but that doesn't worry us. We feel pretty good about it.
A question comes in which asks, there's the long-term view of storage was always originally land banking, and now it is assembling itself into a full-blown asset class or a sub-asset class, I suppose, in its own right. Is there a long-term view which says this site may be reconverted someday into something totally different? And do we intend to carry it to that point?
I don't see that, frankly. I think when you've created that much value, building a product for a specific customer, that in that location is probably the highest and best use for the foreseeable future. If there is, if density were really to become an issue in Houston, and this became the new downtown, so to speak, then maybe that could be revisited. But Houston is a massive city. I mean, it is, you can drive for several hours in Houston and not exhaust the city. So I really see it as being a storage play for the foreseeable future.
Fantastic. We don't have any other pre-submitted questions. And if any attendees have additional questions, you have about 30 seconds in order to ask them. You can see Y Street Capital's website on the screen, as well as our phone number, and that QR code will take you to our investor portal where you can review both this opportunity and some others that we have. It's worth mentioning that this specific asset is also dovetailing in with our storage fund. And so if you want some exposure as an investor to other asset classes or other sub-asset classes within the storage segment, our storage fund, which is investing in this project, may also be a good fit for you. And we're delighted to discuss that as well in a discovery call. But if you know us and you know your goals and we know your goals, we'll be delighted to have you along. Victor, will you round us out with perhaps a little take-home story about Y Street's vision and how our values play into these investments?
We do have one more. Question from Jack. So let's go to that one. So why don't you read that question? I will mention, by the way, that for those of you who don't like QR codes, and I know there's a few folks out there like that, and you still want to get into our investor portal, just go to our website. There's a button, click on it, go under investors, and you can register for the investor portal there directly on the website. It's very straightforward. So just ystreetcapital.com will get you there. You don't need the QR code, although for many people that makes it easier.
There is also a link in the chat. So, link in the chat is there. Jack asks, how does this project dovetail into your Y Street Capital mission of providing excellent product and services that enhances the lives of the users? This is one of the reasons he got out of the self-storage business. Mm-hmm. So how does this dovetail into our mission?
I think we're really all about community building. And so community building means you need all of the things to live. And that's one of those things that is often overlooked. So for example, within the storage segment, we are also playing in a couple of other areas. For example, we're active in boat and RV storage. Even in many primary markets, there's a shortage of boat and RV storage. There's a shortage of industrial storage. There's other things in the storage segment that are important as part of community building. And so that's why we play in that space. And some of those segments can be land banking. Boat and RV storage could be land banking as a way of acquiring that land for potentially repurposing it down the road. Meanwhile, having a great revenue stream in the meantime. So we like storage. We very much like storage.
Victor, I think you have a project in mind that illustrates a little of how we view our own investments and where they fit into our strength. Why don't we end with that?
There's a lot of folks out there that are building commodities. And the problem with commodities is that they're indistinguishable from the next. If a gallon of gasoline is 5 cents cheaper across the street, you'll go to Sunoco. You don't care if it's, ExxonMobil. And that's the very definition of a commodity, because you don't see a difference. And when you don't see that difference, the discussion always degenerates to price. When we developed the Sage Oak assisted living and memory care facility, we built the first one in Lake Charles, Louisiana. Gone on. Our partner Lower Hornbuckle went on to build a replica of that in a suburb of North Dallas. The thinking was not to build just another old age home. We really focused on design and designing the product, not just from a physical standpoint, but the entire service offering. So we actually won the Senior Housing News Architectural Design Award in 2021 nationally in the memory care category. And we don't go into this to win awards, but it was really it was taking that design concept and thinking through the product offering from start to finish. The design of the kitchen, I'm sure you've been to friends' houses and every party is turned into a kitchen party. Well, that's what our kitchens are like. It's like a kitchen party. It's like Thanksgiving every night. People don't even want to sit in the dining room. They all want to be seated at the island. The island is like 18 feet long, with a long row of stools, and everyone wants to be at the heart of the action. It's amazing. So it's really designing and animating a property so that people really can interact with it. And you see it in the reviews. These reviews literally make your eyes water. And let me tell you, when you read reviews in senior housing, most of them are not good. Like, they are not. And they are consistently 5-star reviews in our property. And I just love to read those, because it's about animating the property. It's about delivering a full service offering and just making a difference in the marketplace. So that's what we aspire to do. That's why we do it. And a friend of mine once said, you want to do good and do well. So we like to do both.
Please join us in this offering if you are interested in this self-storage asset, and we will be delighted to have the conversation with you and explore what we can do to be of service. Thank you all very much.